Hey everyone, this is Paul with my video series Darn Good Advice. Today's Darn Good Advice asks the question, when is it better to pay the mortgage off early or invest the difference instead? Now, there are some variables because this is not a one size fits all question, which is why there are so many videos on social media asking this question and coming up with different answers. So, depending on the term of your loan, depending on the interest rate of your loan, depending on the amount of money that you can throw at your mortgage and or put into an investment instead, and we're just going to assume a 10% return, those variables change the landscape of this discussion dramatically. So I encourage you to watch this video all the way through because I run the numbers for you in two different ways, and I think you're going to be a little surprised. Hey everyone, this is Paul doing a comparative video on whether or not you should pay your mortgage off early or if you should invest your extra cash in the stock market instead. And when I say stock market, I mean getting the average S&P 500 index 10 plus year return of 10%, right? Some years it's high, some years it's low. Over time, it averages 10%. So the easy conversation, the easy math is, well, if I have a mortgage rate that is less than 10%, wouldn't I come out ahead putting my extra money into an investment instead of paying off my loan early and getting rid of my mortgage? Well, that is the question we are here to answer. Now, the interesting thing to keep in mind is that you are obligated to up to 30 years of compounding on your mortgage. Okay, so the money that you earn must be tabulated out until 30 years or the term at which the mortgage was going to be paid off. So let's do this calculation first on the mortgage and see how the numbers play out. So this is a uh, Excel worksheet available through Microsoft for free. File, new, loan amortization. You can get this right on your computer. I added these little fields right here showing that we are going to take our established interest charge, the number of payments, and use that as a base of reference. Okay, so I did a Google search. What is the median price of a residential home in the United States? Subtracted a 20% down payment, and we have a loan amount for the difference of $335,200. Did another Google search. What is the average mortgage interest rate in the United States? Today it is 6.6%. A 30-year loan with one payment per month for 12 payments a year, starting today, the day I'm making this video of 8/20/25, and we are, as of right this instant, not making any extra payments, which means a monthly mortgage will be $2,140.78. 360 payments forecasted, 360 payments actual. We've done no extra paying. And at the end of this loan, we will be paying, in addition to the price of the house, $435,482.37 in additional in interest. Now, I put that number up here because we are going to use this interest and 360 monthly payments as our baseline. You see that this is a 30-year loan, right? These loans, monthly numbers convert to 30 years. If you just do a quick look and compare the total amount of interest to the amount that we borrowed, you'll see that we're going to pay over time a quick math return of almost 130%. You're going to pay 130% more in interest because it's mortgaged. Now, let's do some interesting math. We're going to run this calculation twice. Once with a small additional monthly charge to reduce our principal, and then we'll run this calculation again at a higher dollar amount just to see if paying a little or paying a lot changes the results of our experiment. All right. So let's say that we are going to, on this $335,000 loan, pay $200 a month extra every month until the loan is paid off. You see that this $200 is now cascaded down the entire worksheet. By the way, those of you who have never seen this, this is an amortization schedule, and you'll notice that the more that you pay off interest, more that you pay off principal, the interest amount declines each month. So this is a seesaw or scale. Every month, a little bit more goes to principal, a little bit less goes to interest. So with $200 extra dedicated only to extra principal, what happens to this loan? Well, it was going to be 360 payments. We've now saved 77 monthly payments. We have reduced the overall interest, and by adding $200 a month and knocking our loan from 30 years down to 23 and a half, we have saved, which would have been after tax money in our pocket, $109,499.81. Okay? And that left us with 77 payments at $2,140.78 that we can invest later in life. We're going to make a footnote of that. Let's go back and redo this number. Let's say $600, just for the fun of it. Let's say that you put an extra $600 a month towards your mortgage. What we have now is that we have saved 156 payments. We have reduced our 30-year mortgage down to a 17-year mortgage. Wow, that's impressive. And we have saved $212,000, $653.75. All right. So remember, this is the magic number, along with the number of payments saved. And you'll see that we've gone from 130% down to 66%, which is pretty nice. But this is the magic number. Remember, this was money in your pocket after taxes that you were going to write a check to the mortgage company. And that is important because when we do our comparison, we have to make sure that we end up with after-tax dollars, right? Have to compare after-tax dollars to after-tax dollars. So we have two scenarios here: saving $109,000 and saving $212,000. Let's move over now to the other worksheet and see how the numbers compare. Okay, so now it's time for us to do our comparative numbers. We know what the baselines are that we have to beat. At $200 a month, $200 for the first month, 10% annual growth in the stock market, 10% divided by 12 gives us 0.833 monthly growth rate, see? And $200 every month after that starting, growing, adding in, month ending. The month ending becomes the month beginning. You get your 10% again. You get your $200 again. And we break out the month ending balances between our contribution and what would be our profit. Now, remember, to do the apples and apples comparison, we have to be comparing after tax profit. So I will assume, since this is a brokerage account investing in the S&P 500 stock market fund, that we will pay a 15% capital gain rate. So our profit minus a 15% capital gain this is the number we care about. This is the only column on the worksheet that we care about. And we know that starting at $200 a month, paying extra on our mortgage, ended the mortgage at 283 months, saving us $109,500. You'll let me round up 19 cents, won't you? All right, so $109,500 in after-tax profit. Where do we get that money? 283 months is the number we're looking for. And it is 109,000 falls right in there. Month 260 and 261. So the person investing $200 extra a month at 10% beats the person who was paying on their mortgage early. The person paying on their mortgage early would have gotten this $109,000 at month number 283. The investor came out $31,457 and change ahead of the person paying off their mortgage early. Now, you're not surprised at this, are you? Because you're earning 10% while your mortgage is being paid at 6%. Duh, I'm coming out 4% ahead. Well, let's go and see if that theory holds true when we change it to $600 to start and $600 every month. For the person who did that and paid early on their mortgage, what did they do? They finished their mortgage at 204 months, saving $212,653. So again, we're back into this row of after-tax profit. Where do we get 212,000 at 204 months? So 212,000, where are you? 212,000 happens. Whoa, 212,000 happens here. Happens here at month 224 and 225. This is 20 to 21 months after the person paying off their mortgage early with $600 a month. At month number 204, the investor would have been down $49,849. Now, the homeowner still has month 205 up to 225 to invest their $2,140.78 house payment plus their $600 and $2,740.78 invested for 21 months means that the homeowner would come out $54,000 ahead in profitable money of the investor. Now you're scratching your head, aren't you? Paul, we put more money into an investment that was paying a higher interest rate than the mortgage. There's no way you could convince me that the person paying off their mortgage came out ahead. It doesn't make sense, does it? And it makes perfect sense. I'm going to show you the one thing that everybody gets wrong when they make this comparison. As an investor, you're starting with $200 or $600. You're earning $5, $5.04, $10, $15. And yes, through the power of compound interest over time, this number does get bigger every single month. But you're starting at zero, earning 10%. Your mortgage company is starting at 330,000, even though they're charging you a smaller interest rate. They're starting with a much, 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 much bigger number than $600. Look at your interest. Your monthly interest charges on the mortgage are $1,800. Even at $200 extra, here you go, looky there, $200 extra, your principal increases by $200. Your interest is still $1,800. At $600 a month, your principal goes up significantly. Your interest is still at $1,800 a month. The point is, the faster you get rid of your principal amount with these larger payments, the faster your following month's interests drop significantly. That's where the scale tips. That's where the scale tips. You may be like, oh, I'm earning 10%. I'm only paying 6. I'm coming out 4% ahead. But you're not. But you're not. Because you're starting at zero and the bank is starting at 335,000. You are earning $5. They're charging you $1,800. So the faster you diminish that principal on the front end of that mortgage, the faster your savings actually compound. And that's what everyone gets wrong when they do these comparisons. 10% minus 6% is not always 4%. So you saw that when it was a small amount of money, the investor can come out ahead because you're not destroying the principal and you're not tilting the scale in your favor early enough in the mortgage. But when you pay off that mortgage faster, the scale dramatically tips in your favor away from the investor. So there is a little bit of science going on here beyond the mathematics. Actually, most financial decisions are far more psychological than they are mathematical. In fact, I did a little social science experiment in one of the Facebook groups I participate in, and I asked, yes, it's a little bit of a skewed exercise because I asked financially witty, financially responsible people what they would do if they realized they had, a couple 100,000 sitting in their brokerage account. But even amongst them, we still got answers of I want to spend it. I want to travel. I want to upgrade my house. I want to live it up a little bit. And none of those answers are wrong. The problem is that there are people that will use the argument, well, you build up your investment in your brokerage account, and then if it ever gets big enough, you can just take it and pay off your mortgage if you choose. And the reality is very few people would ever actually allow that account to grow to $200,000, $300,000. It would soon become a renovated kitchen. It would soon become a renovated bathroom or a better house or a fishing boat or a new truck or a cruise or a Caribbean vacation. So that money would not be there to pay off the mortgage. So the best laid plans often go awry, and we learn that all the way back in Of Mice and Men. You may think that you're going to outsmart your mortgage bank by investing on your own and trying to come out, 10, 20, maybe $30,000 ahead. But over time, I think those differences shrink. I think the value of paying off your home as soon as possible is not only mathematically advantageous if you throw enough money at it, but the fact that changing your expense ratio that dramatically that you become mortgage free trickles down and permeates every aspect of your financial health, of your emotional health, of your psychological health, your need to stay at a job you hate, the amount of money that you're actually going to need to go into retirement, the amount of money you need to allocate or allow for in your life insurance and estate planning, all of that changes dramatically the sooner you get out of having a mortgage. So I hope that this video gave you some stuff to think about. We want to make sure that when we give darn good advice, we give you different aspects to consider. That's all we ever aim to do. Folks, here's some more links up there, over there. Like and subscribe. I promise you, you'll find entertaining and informative content on my channel. I'll see you in the next video. Pay that house off. Trust me.